14 of 21 series are aligned with stagflation mild this morning. That is a moderate level of agreement across the 21 series framework, strong enough to matter but short of full saturation. The current macro regime is stagflation mild, with a confirmation score of 14 out of 21. In this configuration, the macro regime reflects growth momentum decelerating at roughly -0.58 on the engine's scaled metric, while inflation momentum is accelerating at about +0.01. The coherence score sits in a moderate band, indicating that the pattern of stagflation-like conditions is present, but not universally reinforced across every layer of the dataset. The same 14 out of 21 confirmation score that opened this brief defines the core of the regime call. Historically, regimes with confirmation scores in this range have persisted around 41% of the time over subsequent 3-month windows when reached from similar starting conditions. Compared to last month, confirmation has edged higher into this moderate zone, while the growth deceleration reading has deepened, and the inflation acceleration reading has turned more clearly positive. Environments like this have historically felt like pressure building under the surface. Cross-asset returns have tended to fragment, with pockets of strength in select sectors offset by strain in cyclicals and longer-duration assets. On the yield side, Treasury conditions are stable but finely poised. The 10-year note remains below the engine's 4.45% trigger band, and the MOVE index prints around 69, which the framework tags as normal rate volatility. Momentum here is effectively yellow. The MOVE reading sits between its 10th and 50th percentile over 2 years, and the 10-year yield is within a predefined neutral corridor. In 9 of 11 comparable periods, when the 10-year subsequently crossed above the 4.45% band and held there for 5 sessions, the inflation composite in this framework showed acceleration within the next quarter. That is a historical association, not a directional statement for today. Labor conditions sit in a softer posture. The engine reads employment growth as subdued and jobless claims as drifting higher, which together assign a red momentum label to key labor series such as PAYMs and ICSA. Red in this context means the rate of change has weakened beyond one standard deviation versus its trailing mean over the look-back window. In 8 of 12 comparable periods where labor momentum registered red during a stagflation-like macro configuration, the data showed that real economy growth indicators continued to soften over the following 1 to 2 quarters. Those outcomes are base rates in the sample, not guidance. Credit and funding conditions, by contrast, remain broadly accessible. The engine notes robust corporate bond issuance and stable spreads, placing credit in a green momentum state. Green here means spreads are tighter than their median over the last 2 years, while issuance volumes run above their trailing average. In 10 of 14 comparable periods with similar green credit momentum inside a stagflation-light macro backdrop, the historical data show that equity markets tended to exhibit resilience, even as economic growth readings cooled. Again, this is how the data lined up in prior periods, not a forward map. For the fourth signal, equity leadership has rotated. Technology benchmarks are under pressure, with the segment down nearly 3%, while financials, industrials, and utilities are showing positive relative performance. The engine classifies this as a yellow sector rotation profile. Dispersion across sectors is rising, and leadership has shifted away from prior high momentum groups. In 6 of 10 comparable periods with similar dispersion and factor rotation, the historical record shows that cross-sectional volatility in equities increased over the next few months, even when index-level volatility stayed muted. 2 if-then triggers frame the current conditional map. If the 10-year yield crosses 4.45% and holds that level for 5 consecutive sessions, the historical sample shows that the inflation composite accelerated in 9 of 11 comparable instances. In past data, that kind of shift has tended to occur during transitions from milder stagflation into more pronounced inflation acceleration regimes. If the fear and greed index drops below 15 and remains there for 5 sessions, the engine recorded a deterioration in confirmation score in 7 of 9 comparable instances. Historically, those episodes coincided with regime confidence moving down a notch, and macro conditions becoming noisier across the 21 series. The map is live. These conditions are being monitored daily across all 21 series. Atlas is the automated, rules-based engine inside Given Analytics. It does two things in parallel. First, it publishes a view of the macro environment, the regime, the confirmation score, and the historical base rates we just covered. Second, it runs a fixed four-layer mathematical framework: price structure, rate of change, risk regime, and market participation, across 407 symbols every trading day. When all four layers agree on a symbol, Atlas records it as a potential long or potential short condition under the framework. These are time-stamped model readings, logged for members to study. The environment view and the condition log sit side by side inside Atlas. They are separate outputs. The regime does not pick the symbols, the four layers do. Members use Atlas to study how the framework has recorded conditions across prior environments, as historical behavior, not as trade selection. Atlas runs the framework. You study the outputs and environment. You decide what to do next. That is the core potential educational structure of the platform. A fixed mathematical process and a separate human decision process. The morning brief is the public surface. The live Atlas dashboard shows the full 21 series regime map, today's mathematical conditions across 407 symbols, and the historical archive side by side. Members study the environment and the Atlas outputs each morning. If you want to track this alongside us, the live view is at givenanalytics.com.